Welcome to the latest episode of our podcast series for financial advisors. Today's episode is Doing Well by Doing Good, a UBS breakaway on building a $2.9 billion mission-driven enterprise. It's a conversation with Ben Valore-Caplan, founder and co-president of Syntrinsic. I'm Louis Diamond, and this is the Diamond Podcast for financial advisors.
At Diamond Consultants, we help elite advisors identify the right environment for their businesses to thrive, whether that's at a wirehouse, boutique, or independent firm. With nearly 3 decades of experience, we've guided thousands of advisors and represented more than $250 billion in assets transitioned. And each year, 1 in 4 advisors managing $1 billion or more who change firms are our clients. Our process is education-driven and based on building relationships, starting as your strategic partner well before you're even thinking of a move. To schedule a confidential conversation, call us at 908-879-1002. Wondering why advisors change firms and where they're headed? Are transition deals going up or down? Those very questions and more inspired us to create our annual Advisor Transition Report. It's the award-winning, data-driven resource designed for advisors that connects the dots between the motivations around movement and the firm's appetite for top talent. Arm yourself with the knowledge you need to make smart decisions. Download your copy at diamond-consultants.com/transition report.
In a landscape where most RIAs are designed to serve wealthy individuals, Ben took a different path, one rooted in advising nonprofits with a focus on mission and purpose. After starting his career at Payne Weber and later UBS, Ben left the wirehouse world to launch Syntrinsic Investment Counsel in 2008, an RIA built to serve foundations, endowments, and values-driven institutions. What started as a niche has grown into a $2.9 billion firm, known for its conflict-free model and deep alignment with client missions. In this conversation, Ben shares the story of Syntrinsic's growth from launch to sale, including why he decided to sell the firm to IMA Financial Group in 2023 and what made that cultural fit work. We also talk through what it takes to serve institutional clients in a differentiated way, how mission-aligned investing has evolved beyond just ESG, what advisors can learn from philanthropy and nonprofit strategy, and how to scale without losing purpose or culture. Whether you're focused on growth, purpose, or both, Ben's story is a valuable reminder that building a great firm isn't just about scale. It's about clarity, intention, and doing the work that matters. Let's jump in.
I'm so glad to be here, Louis. Looking forward to this conversation.
Very good. I've been looking forward to it too, because your business is so different than others. You have a really interesting and I think compelling and worthwhile mission as part of your company. So let's not delay it and get to it. Let's start at the beginning. What drew you into wealth management, but more specifically, the institutional consulting vertical early in your career?
Sure. I'm one of those people who came to this after another career. I spent 10 years as an educator and nonprofit entrepreneur. And then when I was about 31 or so, I sat down with a number of very successful people across a whole array of industries and tried to figure out what I wanted to do with the rest of my life. And found through those conversations an opportunity to be a bridge between the finance sector and the nonprofit sector. And thought, there's something there. I didn't really know what it would look like, but I felt in my gut that there was an opportunity there. So decided to dive in and see what would become of that.
And how and where did you dive in?
Sure. I had an opportunity to start at the old Payne Weber, which within a few weeks of me joining was acquired by UBS. So I really started my career at UBS. Yeah, the timing was actually fascinating. My first week was the week that the NASDAQ bubble crested back in early 2000. So I dive into the wirehouse world at UBS as that whole world is about to go through a really difficult period.
That's fascinating. And when you joined UBS, I think even today, there's teams that are more institutional consultants, like you have Greystone Consulting within Morgan Stanley. There's plenty of institutional consultants within Merrill and within Wells Fargo and UBS. Was that kind of your start? Was I want to provide investment consulting services to nonprofits, endowments, foundations, or did you come in the more traditional way, which was let's offer investments to two-legged individuals?
Absolutely. For me, it was very much the opportunity to start a business serving nonprofit institutions. I mean, that was what my passion was. It was the reason I did it. When I joined UBS, I started at the very bottom. I didn't have any background, if you will, in the space. I had an MBA, but I didn't have any pure investment experience. I've been a nonprofit entrepreneur for 10 years. So I started at the very bottom. Once I was in that cycle, though, after about 4 years, I became one of UBS's institutional consultants. They had acquired an old unit from Kidder Peabody called Prime. And I became one of, at the time, maybe 20 Prime consultants around the country for UBS. And then they rebranded it to UBS Institutional Consulting.
What was, in your view, the benefit of building a business from scratch within UBS and then Prime and then UBS Institutional Consulting?
I didn't know what I didn't know. So I really was just looking for a starting place and happened to get an opportunity at Paine-Webber/UBS. And that's why I started there. It wasn't like I did a ton of research into what about Merrill Lynch, what about Morgan Stanley, what about Goldman, et cetera. It was more the opportunity that emerged was there. So I dove in there. I was definitely a non-traditional hire for them. In fact, I actually failed personality inventory that they gave me at the beginning as part of my application process. I did okay on math and logic, but I failed the personality test and had to actually persuade them to hire me on a provisional basis, which was a whole funny story on its own.
Well, it all worked out in the end. So a couple years later, you broke away and launched your own RIA firm or your own fully independent institutional consulting firm. So we'll talk about that. But I realized, like, I didn't ask you, just at a baseline, what's the difference between institutional investment consulting versus wealth management? I know there's sometimes an intersection and they're related. What's the meat and potatoes of your role and how you serve clients?
I don't know that I could say there's a single answer across the industry. I think we all have our own personality, our own way of doing the work. I think having been an educator throughout my life coming into this, I approached it very much through that lens, partnering with clients to really understand where they were at, where they wanted to go. And a lot of times they didn't know entirely where they wanted to go. And so a lot of the work is around defining objectives, clarifying priorities, but then also working within the context of the personality. Organizations are interesting because they actually do have personalities and they do have DNA and culture and norms, even though generally when you're serving an institution, you might be serving 10, 15, 20 people at a time and directly, and those people will be rotating as terms come up or CFOs rotate out, new CFOs come on board, et cetera. So it's a really interesting dynamic. And I think a lot of the difference has more to do with that part of it. I mean, you're basically advising a business. The business happens to have a social function. That's just very different than helping someone think about what they're trying to accomplish in retirement or what legacy they want to leave for their kids. Same questions, but just a different way of navigating the process of addressing those questions.
And the difference between institutional consulting versus being more of a institutional asset manager is that you're not building your own proprietary portfolios or selling like your large cap growth portfolio to a nonprofit or an endowment. You're instead analyzing separately managed accounts and alternatives managers and the like. Is that accurate?
Yes, we're serving as that advisor and trusted partner. We don't use any proprietary products. We're not building ourselves portfolios of securities, but we're figuring out once we've determined what the allocation needs to be, who are really some of the best managers to implement different parts of the portfolio. Where should we be using passive indexes? Where do we want to make tactical overweights or underweights in the allocation? We're leaving security selection to the other parties.
Very interesting. And I'm sorry, I'm just bombarding you with probably basic questions for you, but I think it's helpful just to understand some of the key differences between the way
Sure.
you advise clients versus more of the planning oriented financial advisor of today. So one more, we'll say, basic question for you. If a nonprofit or endowment did not hire you or a firm like yours, What would they do with all their cash and their donations and the endowment funds? Would it be like a CFO of the endowment or nonprofit or foundation would manage it themselves, or how would that work?
Yeah, sure. 20 years ago, when I started doing this, we did run into situations where CFOs or small committees were self managing portfolios. We don't see nearly as much of that anymore. And some of it's just the complications and sophistication required to do the work has just increased. I think a lot of it, though, and perhaps the main motivation is just a greater recognition of fiduciary responsibility and the liability that gets taken on if you're CFO of a $50 million endowment and you're just picking the investments yourself. If something goes sideways, that's tough.
Yeah, seem like much upside.
And quite honestly, folks in those positions are rarely paid enough to justify the amount of professional risk they're taking to do the work and the time it takes to do the work well. So if someone doesn't hire a firm like Syntrinsic, there are boutiques like ours that specialize in that work. I guess an alternative would be going with one of the wirehouses or a private bank or a trust company and having them do that work. I don't really see folks self-managing very much anymore. It's just not, I think, a tenable option.
Understood. So I think it was, correct me if I'm wrong, around 2008 or so, another good timing move. You decided to break away from UBS and launch your own RIA or fully independent investment consulting firm. What was the motivator behind that? Like you were definitely early to the party, breaking away. Then you weren't in the business all that long. So what was the driving factor?
Yeah, so 2007 rolls around and I was fortunate to have opportunities with UBS to spend time with senior management in New York every quarter through '07 into '08, both talking about the evolution of the institutional consulting practice at the firm level, but also meeting with senior leadership to talk about just where does the firm itself go. And I had this vision. It was a little of one of my many tilting at windmills moments where I had a vision where UBS would strip out all the conflicts of interest that are just a natural part of the wirehouse world and mandate and voluntarily take on fiduciary responsibility in the truest sense of the word across the firm. And that was not something any of the wirehouses had done or have done since. But I really was hopeful that UBS would be the first, and then we would be able to use that strategically at the firm level to be more competitive and ideally do a better job for investors, both private clients as well as institutional. So I was spending a lot of time on that effort. And then by early '08, a lot of the cracks of the great financial crisis were starting to really show up in the markets, whether it was in cash management or short-term debt, et cetera. The collapse of Bear Stearns, et cetera. And I basically reached out to my UBS colleagues and said, hey, are we going to be going in that direction at all? And got a pretty clear no. So then that created an opportunity for me to really reflect on, well, what are my other options? Going to the other wirehouses would have really just been a change in name. It wouldn't have been a change in structure. So that, in my mind, wasn't compelling. And so I thought maybe this is the opportunity to learn what it would be like to create my own firm.
And the conflicts that you're talking about with the UBS or any major brokerage firm are things like managers pay for distribution or they're like some advisors charge a commission. What are some of the other like major conflicts that had an impact on how you service clients?
Within UBS, I was able to do a lot because I was on the institutional consulting platform. We were able to either avoid or neutralize a lot of the conflicts. So it's things as simple as trails and 12B1s and other soft dollar revenues coming back that are under the table that the investors don't see. Certainly the whole pay to play to get on the platform structure, quote, due diligence trips that cost thousands and thousands of dollars to participate in that are a normal part of that culture. But even things like where do the managers trade through and how does the firm issue lines of credit? Are you using hedge fund managers that are also using lines of credit issued by the same parent firm? So there's the explicit proprietary product, which is really easy to identify often. But there's a lot of the other elements. Why is that money manager on the platform when, they're third quartile consistently, they're very expensive and not doing anything differentiated? And a lot of times when you're wrestling with those questions, it does come down to financial incentives. It's not just that there are conflicts and it's a pay to play structure, a legal pay to play structure, which I think is important. It's also the lack of disclosure. It's just very hard for investors to understand what all those relationships are and to really understand how much they're paying for investment management services. It's just, yes, if you read all the fine print, can you figure it all out? Sometimes maybe uh, it's not meant to be transparent to the investors. And I think that's difficult. An investor shouldn't have to wonder why their advisor is recommending something. It should just be only because it's in the investor's best interest. And that's simply not always the case.
So, would you say that your decision to leave the UBS institutional consulting unit to start the RIA, was it because philosophically you personally just couldn't see your way around some of those conflicts you just mentioned? Or was it because you were losing clients or missing out on RFPs and it was impacting the growth and the service of your business? So, was it more like you kind of saw what else was out there and couldn't unsee it? Or because your clients were actually flagging this as an issue?
Yeah, I think I was probably more aware of it as an issue than most of my clients were. We worked pretty hard. I mean, anytime we got trails from a money manager, we tracked that. I had one person on my team who all she did every day was look up every soft dollar we received, and then we'd credit it back to the clients. I mean, it was insane. And we would have had to do the same thing at Greystone. We would have had to do the same thing at Merrill. Like, none of this is unique to UBS. I think that's really important. There were many things about UBS that were lovely. I feel very fortunate for having had the opportunity to build my career there, or at least start my career there. But to me, it was really more just a strong sense of there's a way this work should be done. And I want to do it that way. And to do it that way, I'm going to need to build something that is designed to do it that way. Waiting for the SEC to change the rules, waiting for the firms to change their practices, that was not going to happen. So let's just go build the firm that does things the way we think they should be done, and then just do it. And don't wait around using the SEC or using the big banks as an excuse. Just go build the firm.
I love it. Everything else we'll talk about is more forward looking or about your business today. So, your business today, Syntrinsic, give us a sense of the size and scope of the business, the size of your team, assets under advisement, and what the kind of breakdown of clients looks like.
At this point, our firm is advising on $2.9 billion. 90% of the assets are represented by foundations, endowments, and nonprofits. The other 10% are private clients that are philosophically aligned with the nonprofit sector, but aren't themselves nonprofits. There's people who give back, people who care about more than just maximizing return for themselves.
Hmm.
We have 17 people on the team dedicated to taking care of those clients. We approach clients as a team. We don't have a whole bunch of different advisors running around, doing their own thing. We have one centralized research team that is really pulling together best ideas around allocation, tactical shifts, managers. All of our advisors are leading client relationships, but if I'm covering for one of my colleagues or one of my colleagues is covering for me, the client's going to have a reasonably similar experience in terms of the outlook on the economy, the way we've structured the portfolio. We obviously have our different styles, but there's really one voice when it comes to the advice we're getting.
Hmm.
We have a handful of colleagues at the firm that now owns Syntrinsic who are part of our day-to-day, but are behind the scenes, whether it's Lisa on the team who's supporting billing, Valerie, who's our chief compliance officer. They're not one of those 17. They are, in a sense, our team. We're based in Denver. Our clients are all over the country. 60 of our clients are institutions. We have about 28, 29 households, private client households. We really focus on building a really strong long-term strategic relationship with our clients. And so we have a 99% client retention rate, despite all the turnover that happens with boards and committee in the natural course of the evolution of families as well. So that's something that is an important metric.
And I know from, I think, how we met was I saw a number of articles that your firm was highlighted in because of not just the institutional consulting niche, but more specifically what you do with ESG or with sustainability. So can you talk a little bit outside of the objectivity of the RIA model in serving institutional clients, more about the real differentiators of Syntrinsic versus other institutional investment consulting firms?
Yeah, no, that's great. I think the first differentiator is probably we're not trying to be all things to all people. So we know who we serve, and I think we serve those folks well. We turn away a lot of opportunities as well, simply because that's not in our wheelhouse. So we are able to speak with one voice in part because we know who we serve. That just helps a lot. In terms of differentiators, besides that, I think that we do try to approach every relationship as a strategic partner. Really does inform a lot of what we do. So a less is more approach. Let's have fewer clients, but let's serve them more deeply. That certainly helps cultivating longer term, more resilient relationships. And then one of the other areas that's always been a part of what we've done, even going all the way back to the days at UBS, is for a lot of our clients, investing in alignment with their values is important. It's not for all of our clients. I think that's also good to note. But a lot of our clients want at least a portion of their portfolios to be consistent with their mission or values or objectives, social objectives. And interestingly for us, that actually started in the faith-based space, going all the way back to 2002, 2003, with clients who really wanted to make sure that they weren't conflicting with their values in how they invested, both playing defense by excluding certain types of investments, but also playing offense by proactively investing in things that supported their mission work. So we've been involved in that space for over 20 years. And along the way, at times it's been called SRI, socially responsible investing, mission related investing, sustainable investing. More recently, ESG became a term, environmental, social, and governance. Impact investing is a term that we've used for a while that is also out there in the industry. All of these things have their nuances and differences, and you can have wonderful debates about what exactly each of those terms means. What we try to do is just recognize that all of these are values related investments or ways of approaching in a way that's consistent with one's values. And that has been a part of our work for over 2 decades, and something that we do prize our ability to have those conversations with clients because it lets you into a different side of the relationship and a different way of getting to know your clients. It's important to us also that we're not imposing our values on our clients. Obviously, we have values, but we're not one of those firms that has sort of a monolithic view of the world, and everyone we work with has to adhere to our view of the world. We feel that our job is to help our clients go through a discovery process, clarification process with their own values. And then coming out of that, we can help them determine how best to move forward with their investing.
What would be an example, without sharing the name of a client, but let's say a client or a prospect who had fill in the blank, had X value, and then what was the Y, the variable Y that you helped them with? What type of investment strategies did you carry out differently for them than someone else who had a different set of values?
There are certain themes that are easier to manifest in the investment markets than others. So one theme, and maybe I'll focus on it this way rather than talking about just one client, but one theme that a number of our clients value is the ability to allocate capital to communities that have a hard time accessing it. And that could mean investing in a loan fund that is targeting making loans to very small businesses that are owned or led by people who are traditionally going to have a hard time getting bank loans. That would include veterans, the military, women in general, people from different minority groups where they're just far less likely to be able to get loans from traditional banks. And so they have to lean on credit cards, payday lending, if possible, friends and family. But a lot of times, folks in those situations may not have access to capital through friends and family. And so there are investments that we use that help allocate capital in that direction. And it's not meant to be concessionary. The return on one of the funds that we use has been in the kind of 9 to 10% range over the last 3 or 4 years. It's working fine. So it's working fine financially for our clients, but it's also helping them manifest something that's important to them.
Very cool.
Yeah, you could do similar ideas around sustainable farming or sustainable agriculture, where there are funds that exist that help get capital to farmers who are trying to build out more sustainable practices on the land that they're caring for. And there's a capital investment on the front end to get that done. Ultimately, it can be quite beneficial to the farmer as well as to society. But it's that upfront capital that can be so difficult. So that would be another example of a space where we have clients for whom that's an important piece. It makes financial sense, but a big part of the driver for them is a change that they're hoping to manifest in society.
I think it's so cool. I mean, I've heard people call it the double bottom line. You're just giving the money away or you don't care about returns. You're still a fiduciary and trying to maximize returns in the scope of the client's goals. But it's clients feeling good about the way that their funds are being invested. I think it's a really cool way to balance two oftentimes conflicting priorities.
I agree, Lewis. I think that's a good point. What's a little tough and what gets difficult sometimes is being honest about the social impact of investing. I think a lot of the debates you see around whether or not someone should try to manifest their values in their investments is a recognition that it's actually very difficult to move the needle societally, particularly through public equity markets. In many senses, the clients who want to have the most meaningful social impact end up looking a lot more toward private markets. You can be a little more laser focused, well, or a lot more laser focused on addressing a particular issue. Public markets are just difficult because of the nature of how publicly traded companies operate. So that's one of the other pieces that we spend time with folks is, well, what's your motivation for wanting this values alignment if you want it? How much of this is about signaling to stakeholders or to the community? How much of this is about really actually trying to solve a problem? How much of this is just trying to avoid something that bothers you or doesn't fit your value schema? And so it's a lot more difficult than I think sometimes the industry makes it seem, where, yeah, it's not like there's just good companies and bad companies and there's a list and we all agree. It's way more nuanced than that, as you saw.
Right. I would imagine, I'll answer my own question here. I was going to ask you about how additional flexibility and especially manager selection and availability has really evolved your business since leaving UBS. But I couldn't imagine that UBS or any major firm has too many sustainable agriculture funds on their platform. So would you elaborate on that point or validate that I'm on the right track?
Yeah, it's interesting. I was a little anxious, quite honestly, as we launched our own firm about access and have found that anxiety to be misplaced. I think what's been really nice as an independent firm is we are able to source from an incredibly wide spectrum of managers, including managers who explicitly don't want to be larger, more conventional platforms for a whole host of reasons. It also allows us to consider managers that have more niche strategies. So if a sustainable ag fund, and I'm just leaning into that example, is just trying to raise 100 million in capital, it doesn't make a lot of sense for them to be on wirehouse platforms or even with much larger firms like Mercer, Cambridge, et cetera, because they simply don't have the scale. And those larger firms aren't going to invest the time and energy to do the due diligence and have all the accountability for the research, et cetera, to put really small funds on their portfolio or on their platforms. And then similarly, managers that are doing more innovative, newer approaches to solving capital problems. A lot of times, the larger firms, the more established firms, they want to wait to see fund 5, fund 6, or they want to wait to see a company have $1 billion in assets before they're going to allocate capital in that direction. As an independent firm, we have more discretion, use sound judgment to identify managers that are going to be a good fit for our clients. We're not trying to sell across a platform that's servicing trillions of dollars. So we're able to do some really interesting things that are much harder to accomplish and really, quite honestly, often not possible to accomplish at many of the larger firms.
Yeah, it sounds that way. Let me ask you this. I mean, I spent a decent amount of time in the institutional consulting world and even just understanding the way many advisors just think about the world. I know there's a lot of advisors, especially who are serving institutions, who believe that the deep pockets and the brand, and I guess the accountability, if you will, of working for a major firm is what they need to service their clients in the most robust fashion. So, in your experience, do you think institutions really care about platform affiliation, or is it more about the relationship, the trust, and the outcomes that you provide?
Yeah, I mean, I think, yeah, there are institutions for whom what they want to be able to say is, hey, we hired this big firm, and if things don't go well, no one will blame them for having picked a big firm that everybody knows about because they can say, yeah, but they're huge. And then there's folks who've either had that experience and found it unsatisfying, maybe 2 or 3 times even, who are more focused on what kind of a relationship can I have and what kind of service am I going to get? I could be a C client at XYZ super large firm, or I could be an A client at Syntrinsic. And which is more important to me? And I have to say, quite honestly, there are times where we meet folks and we're like, they really need a big bank or they need one of the really large consultancies. And even though they're going to be a C client at that place, their personality is such as that's what they want. That's going to be a better fit for them. And then there's folks who they really like the boutique, high touch, niche experience that a firm like ours provide, and other firms that are more sized the way we are. So very client specific, not really a right or a wrong on that one. Sometimes folks sort through all that when they're going through the RFP process. They can compare things side by side, and then they find that they're drawn toward one or the other. And there you go. They often don't know until they're going through that process.
I think it's a great answer. Different strokes for different folks, and there's enough business and enough clients to go around where you don't have to be on your soapbox and say we're the only way to service people. Because similar to what's the right affiliation model for an advisor for their clients, there's a lot of right answers. It comes down more to the goals and what's most important, and nothing's going to be perfect.
Yeah, I think one of the other things that's interesting is, right, so I'm an entrepreneur. The people who join my team are generally, especially Akasha, my co-president, like entrepreneurial. And a lot of folks who are on the boards and committees of the institutions we're serving are entrepreneurial. That's why they're there. They've been successful entrepreneurs and they value that. So it's interesting because sometimes people look at that entrepreneurial spirit and like, that's so cool. Oh, that makes sense. And that fits with us. That fits with our entity's ethos. But then there are times where people are like, ooh, boy, I want something that's steady and not exciting and not entrepreneurial. And I want to know that XYZ Bank is still going to be here. And if I might be getting a C level consultant, but when they leave and go somewhere else, I'll get another consultant and the statements will all have a familiar name on them. And I want that sense of stability. So again, both legitimate.
Perfect. Thanks for sharing that. Let's pivot in another direction here. So in 2023, you decided to sell Syntrinsic. What led to that decision and what did you look for in the right partner?
Yeah, sure. So, I mean, just for context, I had thought when I started doing this, the goal was to get to 10 people and $1 billion. Like that was nirvana. And then everyone back in '08, the idea that you get to $1 billion, you have 10 people on your team, like that was it. That was the golden ticket and you had arrived. What I don't think any of us really anticipated is how much consolidation would come into play in the RIA space. Well, coming out of the financial crisis, you had a bunch of former Wall Street folks team up with a bunch of private equity folks and go out and just start doing these massive roll-ups. And so by 2020, 21, we're managing over 2 billion in assets, but we're competing against firms that are 10 billion, 40 billion, 70 billion more. And it's like, wow, this is intense. So we actually in 21 looked around and tried to figure out if we could acquire and grow. We'd always grown. Everything we've ever done had been organic. So it could be growth or acquisition. And we just found in 2021 that the valuations were so ridiculous, off the charts. It's already hard enough trying to find potential partners where you have a good cultural fit, a good clientele fit, et cetera. But then the valuations were just totally illogical. I would have to self-finance anything that we were acquiring. So like, I just couldn't make the numbers work. So we stepped away from that process. The bankers who'd helped us on that process had then reached back out to us in early 22. And given what you guys do, how you do what you do, the unique client niche you have, we think there's a lot of folks who'd be interested in partnering with you and acquiring you. So we thought a lot about it and thought about the challenges we were having with dealing with human resources, dealing with legal and compliance, maintaining investments in IT. One of the things I'd always wanted was to be able to have our employees participate in stock ownership. And other than my most senior partner, we couldn't figure out a mechanism for granting stock ownership that actually would be meaningful to members of the team. And so we have all these issues. So we started a process and put our names out there. Well, not our names. We put out our profile. We masked our name, but put a profile out there and found that there was a lot of interest. And some of that interest was more compelling to us than others. So I narrowed it down to about 4 different firms that were each really different. And partnering with any of those 4 would have been a really different experience for us, to some degree for our clients as well. So, and I don't just mean the financial consideration, that was all within the same zone. It was really more, what would being a part of that firm look like? I mean, when we opted to partner with IMA, it was largely because we would still continue to operate as Syntrinsic. We'd retain our name, we'd retain our clientele. IMA did not have a business like ours already, so we would not have to worry about losing our sense of autonomy. And we felt that it would be something that most of our clients would be comfortable with. Some of the other scenarios would have forced us to take on changes that would have probably triggered a lot of our clients going out to bid. And that was not something we thought was very interesting. It was a risk we just weren't willing to take, even though the other options were, well, a few of the other options were actually really interesting. So that's like very high level.
Makes sense. And IMA Financial Group, I wasn't aware of them before doing some research, but they're a large insurance company, correct?
They're an insurance broker. And I think what's important there is IMA is not issuing insurance generally. IMA's Financial Group's primary focus is providing consultative services around employee benefits and property and casualty insurance. They do have some other very modest business lines here and there, but at the end of the day, those are the 2 big engines that really drive the firm.
So it makes sense. I mean, I know a lot of financial advisors or business owners are skeptical of insurance broker dealers or insurance companies because the perception that the cultures are really different. They weigh risk in different ways. There's a fear of being forced to sell proprietary products, et cetera. How did you overcome this? I'm sure it was in the back of your mind and probably given the conflict-free nature of your business. Did you have concerns on behalf of your clients?
Yeah, I mean, I think it's important that when IMA, these were obviously all parts of the conversation with IMA when we were going through everything. I mean, we don't sell insurance. We don't want to sell insurance. Many of our clients need insurance, but that's really on their plate. And if they happen to turn to IMA, IMA is very good at that. If they turn to IMA for that support, lovely. But that's not anything that anyone on the Syntrinsic team is bringing to the table. So we're not really dealing with odd conflicts that put us in an awkward position. We don't have really folks telling us how to build portfolios, how to give guidance on investment policy statements, how to work with committees, boards, et cetera. A lot of what's really been most helpful to us has been the infrastructure support around HR, IT, compliance in particular. It's just really nice to have expertise there. And then all of our employees are shareholders in IMA Financial Group. Every employee, 100% of the employees at IMA are stockholders. That is unusual. And 70% of the shares of the company are owned by employees, also unusual. So I think it harkens back to our entrepreneurial roots. I really do think there's something powerful about employee ownership. Just from a wealth building standpoint, from a buy-in standpoint, I think there's a lot of reason to encourage that. In a private company, when you're a shareholder, it's meaningful in a way that's just different than at a publicly traded company where there's literally millions of shareholders, most of whom are totally disinterested in the actual existence, being at the company.
Hmm. So what was in it for IMA to acquire Syntrinsic? Like, it seems like a really good fit for your goals. Like, you didn't have to change your brand. There wasn't any competing businesses. You weren't going to have to meld your processes into someone else. You handed off the compliance, the non-value add activities, got equity in the hands of your team. So it seems like the boxes were checked. What was in it for IMA to do the deal?
What IMA did was use the acquisition of Syntrinsic as a catalyst to create a new platform called IMA Advisors. It's a platform of boutique financial services businesses that are ancillary to the insurance brokerage space and allow IMA Financial Group to start to move toward being, I don't want to use the term full service too lightly because that means a lot, but a more full service institution, diversify revenue streams, but also be able to bring a wider array of services to potential customers. And I don't just mean for cross-selling, but to actually have different customers
Right.
in different ways. And so the acquisition of Syntrinsic it was even before they built the platform. They built the platform in the following months, but it was the catalyst to doing so. And I think that is probably the most significant opportunity for IMA, is to now use this to build that out more completely. I think a secondary benefit is that Syntrinsic within the communities we serve, has a pretty decent reputation for being committed to building stronger communities. Our client retention is really strong. So I think for those who know us, I mean, we're a small firm in many respects, but for those who know us, our reputation is pretty solid. And I think aligns with IMA's larger vision of, being a positive asset in the community and not just being a business that makes money for its key stakeholders, but actually is a gift to the larger community. And I think that's always been important for Syntrinsic. I think that's important for IMA. And so I'm hopeful that we reinforce that.
Very interesting. Has it been a big change for you personally to go from calling all the shots, being the head honcho, to now, I would assume, having a boss and having a board and other checks and balances or governance structures in place?
Yes, that's a switch. Yeah. People who are entrepreneurial, I had started nonprofits before. I wrote a book on leadership. I started Syntrinsic. Yeah, when you go into a situation where you are accountable for the business, but there's a lot of levers you don't control, like budget, for example, that's definitely an adjustment. And I think certainly something worth considering if someone's making that transition. And then the real challenge becomes, how does an inherently entrepreneurial person remain entrepreneurial in a setting, in a larger setting? And I had that challenge at UBS as well. And there's days I do that well, and there's days I could do it better, probably. But it is certainly a part of the navigation that one has to go through.
Fair enough. And thank you for being honest about that. Let me ask you two more questions to wrap us up here. So, I mean, ESG, the term, has become a politicized lightning rod in recent years, whether it was related to the major universities that are in the crosshairs of President Trump and a lot of negative news articles and the like. How do you advise clients through that noise? Or another way to put it, has that been like a major roadblock or impediment to your business, or has it actually helped in some odd way?
I'm not sure it's been helpful or hurtful, quite honestly. I mean, I think we've always been pretty realistic with folks. Like when someone says, well, we want to do ESG investing, there's a lot of questions to tease out. What do you mean by that? And what are you really trying to solve for? Are you really trying to move the needle on climate change? Is that what you're trying to do? Are you really trying to promote or inclusive or more diverse workforce? What are you trying to do? And a lot of times when people say they like ESG, they don't even know exactly what it means, nor do they know necessarily the limitations of it. And quite honestly, as an industry, it's a little confusing. Is Tesla a company that meets ESG criteria? On the environmental side, you could say yes. You could also say no. Certainly on the social side, you could say no pretty easily with Tesla, given its record of employee complaints and grievances, et cetera. What do you do with Meta? Those are two high profile companies that people can get pretty passionate about whether or not they are companies that should or should not be included in ESG portfolios. So there's a lot of confusion around all of that. What we try to do is stay focused and help our clients stay focused on what are you trying to accomplish? Because if you keep it focused on what are you trying to accomplish, you can neutralize a lot of the political stuff and get to the heart of what someone's trying to accomplish. And we have faith-based clients who use ESG strategies, even though politically that's not necessarily their community, if you will, or whatnot. And we have super progressive, pretty far left clients who won't use ESG because it doesn't do enough in their minds, but then they're just traditionally investing. So like most things, and I'm sure a lot of advisors do this, we try to recognize that there are really strong passions around the political viewpoints that people bring to the table. And those have only grown in intensity through the 7 presidential elections that I've been a part of as an advisor. But that if you keep it centered around what folks are trying to accomplish, you can do a lot of good. We serve a very broad clientele politically. And yet, if you put all of our clients in the room together, they'd get along pretty well. And I think they'd find a lot of common ground. If they only met each other via social media, maybe not. But in the room together, a lot of people who are really passionate about making the world a better place. They may have slightly different perspectives on some areas about what that means, but that overarching commitment is there. And that's pretty exciting. And that's part of what makes our work so enjoyable.
No doubt. It also seems like, I mean, you take the passions or the sensibilities or the charge that clients have to the next level. Like I know a lot of firms or asset managers that they're just doing negative screens. Like, okay, we're not going to put Philip Morris and Anheuser-Busch and Remington in our portfolios because they contradict with whatever the criteria is. But it seems like with some of the work you're doing, you mentioned the sustainable agriculture or putting money in the hands of folks that are underbanked, that you're able to take it to the next level, which is, I think, different. Like, I think a lot of the knocks on ESG is that the returns don't necessarily meet the criteria that an investor has. And the just screening something out isn't necessarily invoking terribly much change. Awesome. Last question for you. What lessons or lesson would you offer to a independent business owner or even a wirehouse advisor who's considering the sale of their practice or a partial sale of their practice?
I think it's the same question that those same advisors are asking their clients all the time. And it's really, what are you trying to accomplish? What are you trying to do in your life? Are you trying to exit because you're done and you just want a nice, clean way to take care of your clients, maybe benefit from some of the equity you've built up over the years, but you really are just phasing yourself out? So are you looking for a new adventure and you're still hungry and you've got a lot of years ahead of you and you want to dive in and just, have a new chapter? Are you just trying to de-risk a little bit and take some of your equity off the table? If you're looking for nirvana, that doesn't exist. So, if that's your motive, take that off the list right away. My experience is there are people who they move firms and then they move firms and they move firms and then they move firms and they every 4 or 5 years just go through that cycle. That's its own thing. Sometimes in life, we run away from something and then we go recreate it somewhere else. So that's not always the best motive. But taking the time to reflect on what you're trying to create for yourself, for your family, for your colleagues, for your clients, and mapping that out, which is usually an iterative process as you consider different options. If you do that work ahead of time, that's really key. I think if you focus on maximizing the financial, that's one way to approach it. My experience, and I've had this confirmed by a lot of colleagues, is that doesn't tend to lead to the best results. So spending time on the other issues will help create a more successful transition, whatever it may end up being.
I completely agree. I tell people all the time that it might sound like a little bit too naive or even like a little bit soft, but usually if an advisor or a firm owner finds the right fit, we can make the math work because you have two motivated parties. And even if you're not getting 110 cents on the dollar or whatever your goal is, finding the right fit is worth its weight in gold. And you get one shot at selling your business and you get one shot to make a first impression with your clients. So spot on, Ben. Thank you so much for joining us today. This is a very different type of episode than we normally have, given your focus and your niche, but it was really, really cool to see how you personally match up your own values and experience to serve clients in a unique and refreshing way, and some of the ways that you're helping clients make an impact and a difference in their lives. And especially refreshing too, to hear your honest review of what it means to sell your business and why you did it. So we'll have to do this again sometime, but thank you so much for your candor and transparency today.
It's been a pleasure talking with you, Louis. Thanks so much. And good luck to you and to your colleagues.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibilities seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.